Hi, everybody. It's a little bit after 2, so we're going to get going. Welcome to the webinar on transferable tax credits hosted by Crux. I'm Alfred Johnson, the CEO of Crux. I've spent my career between software, financial markets, and the U.S. Treasury, where I most recently was Deputy Chief of Staff. The Inflation Reduction Act is obviously on the front of all of our minds. It adds enormous subsidy into clean energy and decarbonization, and tax credits are a principal mechanism of that subsidy. And of course, they are made to be transferable for the first time. So this is going to be a key catalyst to the energy transition, and we're excited to talk about it today. So we have a great set of panelists here today. I'm joined by Rob Parker, the Chief Commercial Officer of Crux. We also have from Allen Overy, John Marciano, the co-head of the Global Energy Practice, and Sam Kamyans from that group. Mike Carr is a partner at Boundary Stone, which is a leading advisory practice with a focus on regulatory and policy here in DC. And Michael Orlando is a managing director from KPMG with a particular practice in tax credits. Great. So quickly to talk about the agenda, I'm going to start by giving a quick rundown on this new market for transferable credits. We've got people from all sides of the market on this call with all levels of expertise. So I'm going to lay the foundation briefly before handing it over to John and Sam from A&O to talk about their perspectives structuring many of these deals currently. We'll then hand it over to Mike Carr from Boundary Stone, who will talk about what to anticipate from Washington before passing it to Michael Orlando of KPMG to give the accounting perspective. I'll then hand it over to Rob Parker, who will talk about the emerging market that we are already beginning to see in the credits and where Crux will fit in. And then we'll have a Q&A discussion. You can add questions within the Q&A box at the bottom of your screen, and many of you have already sent some over, which is great. Thank you for that. Great. So I mentioned that we've got people from all sides of the market. We have developers, credit buyers, intermediaries, and advisors. Our goals today are for developers to provide visibility into pricing, structure, and valuation, and what to expect from guidance. For credit buyers, many of whom are new to this market, providing tools to understand the new transferable tax credit mechanism, how you can participate in this new market, and the risks and rewards of doing so. For intermediaries and advisors, sharing information that could be helpful to clients and insight on how technology may be supportive. And for everybody, the goal here is to use real data that we are seeing from the market as it evolves to inform the way that you are approaching the new transferable credit market. So the IRA adds significant subsidy, generational subsidy into an already fast-growing market. The principal mechanism, again, is tax credits. The credits are made more generous at the project level. They are provided for a longer time period, so for at least 10 years. They're provided for more categories of projects than existed previously. And the government created a new mechanism for transferability, and in some cases, direct pay. So I know many of you have spent your careers in this industry. Again, there are some on the phone who are reasonably new to it, which is great. So I'm going to quickly lay the foundation on transferability. There are multiple kinds of tax credits. There are investment tax credits associated with the amount that is invested into a project. There are production tax credits that are associated with the power produced or materials produced associated with an activity. And then there's incentives in the form of credit for advanced manufacturing of things like components. The credits will be bought at a discount to face value. They can be sold to unrelated third parties, unlike the tax equity market, which requires people to be participants in the partnership structure in order to be monetized credits. These credits can be sold directly to third parties that are not otherwise invested in the project, and they're filed by the sellers and buyers. Critically here, one point is that they have a 3-year carryback and 22-year carry forward. So we're already engaged in some early transactions in the market. The market, of course, opened on January 1st, but we're beginning to see early data from a pricing perspective, and pricing is very much at the top of people's minds. We're seeing credits pricing between 85 and 95 cents. I recognize that is a very wide range. The kinds of factors that are influencing price are things like sponsor credit, whether insurance is present in the transaction, is it an ITC versus a PTC, the technology category, where new technology categories are tending to price at a deeper discount in general, and the sustainability characteristics of the credit. Again, we're seeing insurance in some cases be used and to be especially attractive in the case of ITC and for new buyers. We are seeing quite a lot of hybrid structures that integrate tax equity and transferable tax credits. I know that John and Sam from A&O are going to speak more about that. And then we're seeing closing conditions present in deals as they're being structured. So things like seller indemnity and credit support. And then, of course, we're seeing tax opinions and other legal opinions being part of these transactions. So we're seeing transferability across the board in a lot of different categorical areas. I've listed a few on the screen here. I won't read them all, but I will call out standalone battery storage is an area where we've seen quite a lot of inbound to the company of people with credits that they are looking to sell and finding that transferability is an attractive mechanism there, as well as some of these other categories. One area that is not listed on this screen, but is quite prominent in terms of the conversations we've been having, is new technologies and specifically biofuels, which seem to be an attractive area for transferability. So this market, as we all know, is going to have to get a lot larger. The tax equity market in 2022 was $18 billion. It is anticipated to grow to $80 billion or more. I noted that the CBO in their score of the bill that went through the House last night had a new figure on this number. So many are trying to forecast what it will be, and nobody knows for certain. But we all know that it's going to grow pretty dramatically from where it sits today. And if you put that in context of, believe the $83 billion number that came from Credit Suisse in its first use, and put that in the context of total corporate taxes in 2031 are estimated to be $527 billion. So to clear $83 billion, you would need 16% of corporate taxes to flow through the tax credit. So in all worlds, this is going to be a massive new market, and a market where many tax attributes in the tens or close to hundreds of billions per year are going to need to get monetized to corporate and other buyers that are using the credits to advance sustainability objectives and manage their effective tax rates and cash. So in a moment, I'll hand over to Allen Overy quickly to observe a few features of the new market that is forming here. We're seeing simplified contracting around transferable tax credits versus tax equity, and transferable tax credits, again, are often being used in concert with tax equity. We're seeing smaller tickets emerge for transferable credits, and syndication grow as an area of interest across the board. Advisors and intermediaries have played a critical role in this market for a very long time, will play a critical role in this market. Rob, at the end of the presentation, will talk about some of the tools that we think will help advisors and intermediaries do your jobs even more efficiently and grow even more quickly. And then finally, we are seeing emerging financial products and new financial products emerge around tax credits in a really interesting way that should be supportive to market liquidity, and we'll talk more about that. So with that as the initial framing, let me hand it over to John Marciano and Sam Kamyans of Allen Overy.
Hi, everybody. I'm John Marciano, and I'm sitting with Sam Kamyans. We're in the Washington, D.C. office at Allen Overy. And I think it's really interesting that this change came, because when I started doing tax credit work in 2008, I would always have to say, okay, all the tax people, put your earmuffs on, and then business people would say, we're trying to sell these credits, we can't sell the credits, we're trying to come as close as humanly possible to selling. And we did a lot of complicated deals in that fashion. But now we actually have the right to do it, and it's so exciting. And Sam, why don't you talk about some of the things that you've been working on to simplify the transactions and to move it along quickly?
Yeah, no, totally. So we're really excited to have this new feature because, as John said, we were always pretending to not sell credits when I think we kind of were and will continue to do so. And so that made the deals really complicated, right? I think folks on the phone have seen tax equity investments and all the negotiation that goes into the partnership agreements and getting the project set up, going through all the diligence, negotiating the commercial points. And really getting that structure set up. And now we're kind of cutting to the chase and saying, okay, we've got a project, we know it's going to generate credits. Let's go ahead and sell it and try to monetize the credit that way. And so at first glance, it looks really simple, really straightforward. I think once we peel back the onion, we're recognizing, okay, we have this great new tool. It's going to require some of the tools that we're accustomed to incorporating into our projects. And what do I mean by that? It's like, John, I come up to you and I say, hey, I want to buy your credits. What kind of project do you have? Then John tells me, well, I got this great solar project in North Carolina. It's going to produce and it'll have this many credits. But still, at the end of the day, I do need to diligence that project. And so when we're looking at entering into the contract, you've got a lot of these familiar notions that we're going to have to go through of making sure the project works and getting the reports on it to really get comfortable that there will be a generation out there that I can buy my credits off of.
Well, the interesting thing that we have now is that in tax equity, because you're trying to pretend like you're not selling it, there are certain risks that the person that wants to be the buyer of the credit that they have to take. You don't really have to do that here. So we can contract away pretty much all the risks to other parties. If someone wants to buy a credit, they can buy a credit and be mostly immunized to the risk, even though some of the risk will technically be on their side. We can cover them with indemnities and the like, or insurance policies. So it actually gives us a lot of flexibility. And because you don't have to slice and dice those risk profiles as neatly as you did in the tax equity world, the documents I think can be a lot more slimmed down. Now, in the certificated tax credit markets, where there's actually sort of a underlying product that you're buying that is sort of articulated by a governmental entity, you have 3-4 page, maybe 8-page documents. It's probably a little bit longer than that, but it doesn't have to be materially so. So at the end of the day, we've got projects like a solar project that is brand new that you can sell the investment tax credit in full. You can sell, we hope, just a portion related to an adder, or with a production tax credit deal, you can sell credits for operating projects. You can sell credits that are before tax equity comes in, if you have tax equity at the same time. And you can actually do a hybrid of tax equity and transfers in it. And actually that hybrid transaction comes up with, from a math standpoint, a lot of extra value.
Yeah, no, and it's it really leads into the good point of we have existing projects that we can sell credits onto or from, and then we have these projects that are going to go online that will generate credits before a traditional tax equity investor would have come up. So when we think about kind of structuring these transactions, I think one point that's been really neat is historically there's always been 5% of the credits that go to a sponsor that can't really use them. Let's say you got a wind project and you turn it on before the tax equity investor comes in. Now, all of a sudden, what we're seeing in the market is folks waking up and saying, wait, I've got these credits. They're coming to me. Tax equity is not in yet. I can go ahead and sell these. So why don't I just enter into a contract to go ahead and sell them either before tax equity comes in, maybe I sell it to the tax equity investor before they come into the deal. So now that we have all this flexibility, then it comes down to, okay, what are we going to put into these contracts and how are we going to structure the deals?
Well, we used to call it leakage.
We used to call it leakage.
Now we're plugging the leaks.
Everybody's drinking from that trough. So it's really, we're really working on it nicely. So what we're doing now is we're putting these structures in place where you contractually sell whatever credits are not going to be monetized. And so to go to John's point of adders, I think that's a really good example of how this is shaking down. You've got your partnership, it has adders associated with it. One party is comfortable that you're in an energy community. The other party is either not accepting of that theory or they've hit their funding cap and their parent just doesn't let them put more money into the deal.
So the point being is that you've got a credit on a project that might have been 30%, and now there's an extra 10%, percentage points that are added on top of it.
So what do I do?
So we have a number of projects where we have a tax equity transaction that relates to that 30%. And there's the ability of the existing tax investor to upsize. They may not want to, they may not be able to, they may not agree that the extra 10% exists. So how do we set up that transfer, Sam? Can we set it up ahead of time? Do we have to wait until we're totally sure that we have the adder?
So this is the beauty of it, total flexibility. If you think about the mechanics of how transferability works, you make the election on the tax return for the year in which the credit's generated. So if we're in 23, you make an election on your 23 return in 24. And we draft and negotiate into these documents upfront the ability for that company to sell the credits so long as tax equity is either made whole if there was some challenge to the credit, they're economically in the same position with or without the sale. And then that sponsor just keeps the cash. They say, okay, you guys didn't want to fund to it. That's cool. We'll continue doing business with you, but let's just not leave value on the table. So once we hardwire that into our partnership agreements, it really opens the door to making sure that every piece is monetized. To make tax equity comfortable, there's insurance products entering the marketplace that will say, fine, tax equity will only allow you to sell the credit if they're fully insured against any risk. So you can go pick your broker who will actually insure any adders or any other ITC or recapture or whatever is available. So these are making their way into our deals at a very rapid clip to enable little to no risk for the tax equity investor and enable the sponsor to have the right to sell credits that otherwise wasn't going to get money from the tax equity party for.
Now, Sam, are we super comfortable, given that we don't have guidance yet, that we can do all the things that we want to do?
Yeah, no, that's a great question. So one nice thing about the statute is that it's pretty clear in terms of the ability to do it. You can sell as many or as little as you want. There's some partnership nuances that we don't need to get into. But really, the outstanding guidance point is recapture. So historically, if you turn on a solar project and within 5 years it goes offline, that credit can partially get clawed back by the government, vest pro rata over 5 years. The statute says that there's a recapture component to be incorporated here, but we just don't know how recapture is going to work. Will a buyer have to claw credit back to the government if the system turns off? We just don't know. So that's really the one risk that will come out in guidance, but for which insurers are willing to step in the interim.
Great. Well, maybe that's a good place to turn over to Mike Carr, where some of these guidance projects are right up his alley.
Great, thanks. I'm Mike Carr. I wanted to, while we await the guidance, I wanted to see if we could give people a little bit of insight on what the underlying principles were from a congressional perspective. After all, I mean, at the end of the day, Treasury sees as their primary audience the tax bar, but they're certainly among the top audiences that they're looking to please is to deliver on congressional intent. And so just to talk a little bit about what Congress was after in trying to get, in bringing this new transferability and refundability to the fore. I'll go ahead and go to the next slide. There were basically three issues that I think were on members' minds as they were putting this together. One was that there had been a lot of data that the existing tax equity market was too thin and involved too much overhead for a lot of participants. So very, very sizable participants were able, sizable projects, big developers were able to access tax equity markets. But it was often perceived that the cost of that credit was unacceptably muting the signal from Congress through to the end developers. And so they've been long searching for a way to kind of reduce that overhead, both in an administrative sense and in just in a cost sense for a tax equity provider. The second is that with the expansion, and Alfred tipped to this in his earlier slides, with the expansion of the number of credits, the categories of credits that were going to now be available under the IRA, I think there was a general perception across many members that there just simply was not going to be enough tax equity available to deliver on the promise of the IRA tax credits to actually, get all this economic activity moving. And so it needed to, they needed to provide a mechanism to it, at the very least, take a little bit of the pressure off the tax equity markets. So making some of these transferable was a way to do that. I will say too, just so people understand, there, there was a desire to tie particular incentives like the adder that later became the adders to some of these transferability and refundability provisions in order to allow for there to be sort of a stick to go with the carrots. At the end of the day, there was not enough votes for that, and so that part was stripped out. But I think the underlying principle was still the same, that it was necessary to expand the size of this market dramatically. And the last piece sort of related to that is the participants in these markets. Manufacturing credits were dramatically amped up in this across a number of areas, and the emphasis on community solar in economically disadvantaged communities. Some of the adders meant that a lot of new participants would probably be coming in, including some nonprofit, governmental, or startups that had not traditionally had access to tax equity markets. So I think part of the objective here was to broaden and deepen the marketplace, but also make it a little bit more user-friendly for new participants in these markets. So with that as sort of a backdrop, let's go to the next slide, and I'll talk just sort of a little bit about the timeline where we are. So what we have seen so far is Treasury trying to move the guidance along as expeditiously as possible. It is a raft of guidance across several different areas. But I think they have done a pretty good job of moving quickly. One of the consequences of the way they have done it is they have tended to do the rulemakings in these in a somewhat piecemeal fashion, where they will often drop initial guidance, take a comment period of 30 or 60 days. I think often it's been 30 days, more often than not, than 30 days. And then with an eye towards either revising the guidance in an initial phase or for a later rulemaking. So all these are eventually going to be packaged together into rulemakings. But I think the anticipation is pretty strong that we should not see a lot of change between the final guidance as issued after that comment period and then the ultimate rulemaking. So really, I think they really want people to be able to rely on these as quickly as possible. And so I think that they've set up this system accordingly. We have been hearing very recently that the guidance specifically on transferability and refundability or direct pay, is likely to come out in the coming weeks. It's part of what they think of as their first phase of implementation, which they plan to wrap up by the end of May. Some of the tax credits that go into it, such as the 45X manufacturing tax credits, are likely to be in that second phase. So we'll be keeping an eye on both of those. But I think that it is important to keep in mind what that the objectives are is to make this as workable a marketplace as possible, and as sort of seamless for a bunch of new participants, both on the buy side and on the sell side, as this moves forward. And I do believe that from all the indications we're getting, Treasury understands the objectives of Congress in this, and they really are trying to meet that moment. One last bit I I know there are questions because it's currently on the floor. The Republicans have put a debt ceiling measure on the floor, which essentially repeals all of the IRA. Just a couple quick comments about that. I think, we've been tracking that very closely. One is, I think a couple notable things. One is that I think for purposes of, the Speaker's office has been very clear that they are looking to enter into a negotiation, and that this is sort of their opening bid. And as such, it includes a lot of things that he's understood from the very beginning would be unpopular within his caucus. Things such as repealing the nuclear tax credits. There's Defense Department hits in this. There are a lot of the manufacturing. I mean, obviously there's all the manufacturings of ethanol and biofuels. I think so. What he has said, what the Speaker has said is, this is just an opening bid. Let's just all vote in lockstep and get this conversation started. Despite that, a number of members have said they are still not comfortable, and he has already begun to make changes, including the biofuels tax credits, pulling those out to try to gain votes. So I think, even though he has strictly told his caucus this is a largely symbolic vote, even that is not enough to sort of give comfort to his caucus, and he has a very, very narrow margin. This is all even just against the backdrop of these generally being very, very popular tax credits in general being very hard to repeal once they're started. I think all of this combines to us, I think, in a general feeling within the advocacy community that this is not a serious near-term effort. And so we don't have any strong expectation of any radical changes, or really much of any changes in substance at all in the coming, at least in the next couple of years before the next election. Let me just wrap on that point. We can save the rest for Q&A and pass it on to Michael.
Okay, thank you very much. And I think we can move to the next slide. Perfect. So thanks everyone for joining again. I'm Mike Orlando. I'm a managing director in our accounting methods and credits group, focusing on IRA energy credits, and really just wanted to highlight a couple things with you today. One is the accounting. Obviously there's some significant new credits out. There's also extensions to existing credits. There's a lot of questions right now in terms of what does this mean for my financial statements, my US GAAP, as well as my tax reporting line. Also validation and diligence. What we're doing right now is really helping clients really get to the bottom of the new requirements. Also the mechanics, how are these credits working, including the adders, and diligence in terms of the supporting documentation that we think is going to be required. You can go ahead to the next slide. And the next slide. Okay, perfect. So a lot of this we've already spoken about. Reason I included here really is we're really talking about three types of credits when we trickle this down to the accounting guidance and how you would account for this, whether it's above the line or below the line or so forth. You have your refundable credits, your direct pay. You have your non-refundable credits, your historic energy credits, as well as some of the other federal credits that are offered that really can only serve to reduce your income tax liability. And then also the transferable credits, which we know are keen interest, especially today. Let's go to the next slide. One more. Okay, perfect. So from a US GAAP consideration, and again, we're getting a lot of questions in this space. Really what the question hinges on in our interpretation is, how can you utilize these credits? Are they limited to offsetting your income tax liability? Are they potentially refundable above the line, like the direct pay? And if they're transferable, maybe there's a certain complexity where both options are available, depending on the nature of the PTC a production tax credit or the investment tax credit. So with that said, in terms of keeping utilization as kind of the key focal point here, we'll just hit each one of these real quick, starting with refundable. Refundable credits, we think your direct pay type credits, we would advise accounting for that above the line. And what that means is that it's not going to impact your income tax liability. Reason being, how do you realize these credits? It's not contingent on having a tax liability, right? Unfortunately, there's not a US GAAP equivalent to this. We look to grant accounting under IAS 20 or a couple other provisions that we'll go through in the next couple slides. But that's really the line of questioning you should be going down. What types of credits are you generating? And ultimately, what are they going to be used for? Secondly, the non-refundable credits, non-transferable credits. These are the historical credits, right? These are your tax equity type credits. These are the credits that are going to go towards offsetting your tax liability and your income tax. This we would consider below the line. And what I mean by that is follow the provisions in the US of ASC 740, which includes potentially setting up deferred taxes, considering things like valuation allowances, right? And also, very importantly as well, is estimating for your provision, your tax provision, your financial statements. And lastly, we just note the transferability is our third portion here, which we'll get to on the next slide. Okay, so accounting for transferable credits. Now, again, the benefits here, I think as well documented by the other presenters, are new from a federal perspective, really, and the ease of this transferability we haven't seen before in the federal space. We have in the state and local space, but not in the federal space. And the accounting is a bit of a heightened complexity, we do think. We think it is facts and circumstances based on the types of credits we just talked about, based on tax capacity for some of the non-refundable credits. But ultimately, it follows suit with what we just discussed between refundable and non-refundable, above the line and below the line. So first, starting with accounting for refundable, transferable credits, right? So we believe, again, these would default to more of a view as a government grant, right? They're not reliant on having an income tax liability. And this is because the taxpayer can realize the benefit, right? Regardless of whether it owes any tax. Again, there's no US accounting for this. The couple options that we see as kind of a substitute here are IAS 20 for government grants, subtopic 958 for non-for-profits, and as well as 450 for gain contingencies. So multiple options here, and things that the accounting department as well as tax advisors will have to work towards when realizing these benefits. Accounting for non-refundable transferable credits, I think we discussed this. So US GAAP, again, does not specifically address this, but if you do have credits that are only going to be able to use to offset your income tax liability, we would consider these below the line. And lastly, I think from a transferability perspective, again, what are you transferring? What is the mechanism for using the ultimate benefit here? That's going to dictate whether your income tax considerations are below the line, or if you're looking at other income, balance sheet above the line. Okay, I think we can keep moving. So we touched on a number of these, recent guidance. I thought it would be helpful to list it here just so you can see how this is moving. I think we'll save some for Q&A as well. But I did want to highlight some of the adders here because, frankly, all of the credits that we're looking at, we are measuring the adders. We are going through anything that's available right now to help us determine the bonus rates that could be applicable. And we're advising clients on what we think preliminarily the documentation requirements are. With that said, we are still waiting on a good amount of guidance. And a lot of this happens to fall into a gray area as well. That said, just to run through a couple prevailing wage and apprenticeship requirements, right? So significantly higher bonus rates. If you think about a normal 6% base rate, this could go anywhere between 30 to 50%. For some of these credits, if prevailing wage and apprenticeship is met. Documentation is key here. The substantiation is going to fall on the taxpayer. And this is something that, again, this dates back to Davis-Bacon 1930s law, where they look to certain wages of laborers, mechanics, and so forth to make sure that there's a fair wage being paid. A lot of our clients have not looked at this before, or at least in this context. So we're seeing a lot of questions come up on prevailing wage. Energy community, there's a new notice there as well. There's the additional credit amount. If you are located in an energy community, these are for projects placed into service after 2022. There is a preliminary mapping tool that was recently provided by Treasury and the IRS. It's really not as expansive or comprehensive as we hoped. We think that will develop in the future, but it is in existence as of this notice here, referenced here. And then just to circle up the last two here, there was some recent guidance on environmental justice allocation for some of these low-income communities, and then the domestic content requirements, right? So we've seen this before in other provisions in the past, loosely based on some of that, but really the incentive here is to manufacture and produce certain iron, steel, and certain products within the U.S. This is bringing into question a whole slew of follow-ups that we're trying to get further guidance on, but is really making developers and folks that are looking at these credits reevaluate supply chain, right, and seeing if they can meet these various percentages and thresholds to be within the U.S. Next slide. Okay, great. So I really just included this. This is a summary of many things that we've talked about so far. A couple things I'm sure we'll hit in the remaining time here, but I wanted to include it because these are the hot topics that we're still talking to clients every day about. We are, discussing internally with our Washington National Tax team, and we are waiting on future guidance in terms of compliance and how some of this will play out. So that's really why I wanted to highlight it here. Okay. So with that, I'll pass it to Rob Parker.
Great. Thanks, Michael. That was terrific. I'm Rob Parker, Chief Commercial Officer of Crux. I'm really excited to have joined, having spent more than 20 years in the power industry, wearing a number of hats: developer, investor, off-taker at Ellis Power and Rev Renewables, Google, AES. As I think about it, our industry has been given an incredible tool to accelerate our growth, and it's really exciting to be part of that. Before the panelists address some Q&A, I wanted to provide a quick preview of what we're hearing and the role that Crux will play in the market. The key takeaways for this section are: this is a huge opportunity. It emerged virtually overnight, and that it will take all of us collaborating for the industry to really reach its full potential. We're participating in the formation of a new market, and that won't happen on its own. We all have a role to play, and typically, when new markets emerge, there are a number of things that are required. As we talked about, transferability is a new type of financial product, and understanding what the future of that asset will look like, we've drawn on many inspirations from other markets and hundreds of conversations, including many with you all. In addition, we're working on early transferable transactions right now. And from those discussions, we want to share a little bit about what we're hearing. The market is moving in the direction of standards, liquidity, efficiency, and scalability. As others mentioned, this industry looks to massively accelerate deal flow and decrease transaction time and overhead. And people see an opportunity to standardize docs. Our industry has seen this before numerous times with ISDAs, the EIs and NASBs, et cetera. Deals, as John and Sam talked about, won't become one size fits all, but everyone acknowledges the benefit of coalescing around a number of key decision points. Industry participants will need liquidity, in some cases urgently. The deeper pool of buyers and sellers, especially buyers, the more that developers can make more educated decisions and commitments, and parties can also offer more ancillary financial products. And there are a number of financial market examples to look to, just as real estate here. What we mean here by efficiency are a number of key concepts: transparency, risk management, transaction friction, simplified diligence. And we've seen ideas like credit ratings or solutions like insurance solve for this in the past. And all of these concepts drive improved trust, and that drives transaction volume and leads to more steel on the ground which really is all of our ultimate goal here. And lastly, scalability. A number of interesting things are happening, and they're happening all at once. People are anticipating this significant increase in volume and also a massive increase in market participation. You know, as we speak, people are expecting greater portfolio management complexity, and that comes from more syndicated deals and more buyers at a lower average transaction size, like Alfred and others talked about. And from all of that, software is ultimately needed for folks to scale and manage their books in a cost-effective manner. And as Alfred mentioned at the top, we have a great set of people on this call, and you represent all sides of the market. But this market, to reach its full potential, needs software solutions, and Crux is enabling that layer, the ecosystem connecting everyone and managing transferable tax credits. After speaking with so many of you, we're actively building alongside partners to ensure we build the tools and solutions that the industry needs. The starting point for any transaction, on the next slide, is being able to find the right counterparty. What we hear is that both new and existing participants are seeking ways to explore opportunities, interact with each other. Buyers want to easily discover, filter for projects. Developers want to access buyers and to manage their own portfolios. And intermediaries and syndicators want to scale their ability to connect buyers and sellers, as well as build and manage pipelines and portfolios. Once counterparties have found each other, we want to make it easy for everyone to transact and connect. One of the most consistent themes we've heard is the desire for a software package to streamline and manage the transaction process. From RFP and bidding management, to term sheets and diligence, to closing, to post-closing compliance and reporting. We spend a lot of our time speaking with banks, syndicators, and other intermediaries, helping explore and plan how they will scale syndication. As we've touched on, the number of counterparties per deal, the number of counterparties in total, are about to increase astronomically, given that intermediaries will continue to play a critical role in many transactions. We are building the tools for them to manage and scale syndications, as well as offer ancillary financial products inside of a branded environment and to help your clients. Lastly, what's ahead, sorry. We are completing our first transactions, including some with folks on this call. We are building the tools required for you all to manage transactions, and we're rapidly expanding the number of participants and partners that we work with. Lastly, pricing. This comes up in nearly every conversation we have. I see a couple already of our live questions also address pricing from Kevin, Norris, Lucas Gusmanto. The market is currently operating on a few anecdotal points. We want to inform that with real data from you all. And so in the next couple of weeks, you'll all receive an email from us that collects info on pricing and structures. Our goal is to inform the conversation with real data on how deals are actually being structured and at what prices. This will be one step toward increasing market transparency. We are really glad to have you all on the call. We're incredibly excited about this emerging opportunity, and we look forward to connecting further. And with that, I will turn it back to Alfred for Q&A.
Great. So I'd invite all the panelists back on video, and we're going to start with a question about guidance. So this has come up in every one of the presentations that we just watched. Guidance is obviously top of people's minds right now. So I want to go around the horn, starting with Mike Carr, and ask what are you looking for most principally as we await Treasury guidance? I'll go to you and then hand it over to Allen Overy.
Great. Yeah, a lot of the folks that we're working with are in the manufacturing space or otherwise potentially able to get the direct pay. That is a 5-year period. So I think the main things they're looking at right now are managing when to do transferability and then when to do direct pay. And then the other thing is the particular applicability of particularly manufacturing credits to specific facilities versus company-wide. All answers that we think we have a pretty good line of sight on, but I think will be really important for structuring a lot of these manufacturing deals.
John and Sam?
I want guidance to be as delayed as humanly possible. I think the longer we keep the big banks out of the market, the more we will have the ability to build a framework that's actually workable, that is not 1,000 pages per document, and can be more dynamic. That said, if guidance comes out, I'm really hopeful that they tell us specifically what we can sell. Are we selling what I call a vertical or horizontal strip? Is it just a flat percentage of the credit, or can we sell specifically the adders versus not the adders? If we have more than one adder, can we sell them independently? The more flexibility and dynamic nature we have for what we can sell, we can have different striations of risk profile that we can sell at different discount rates. I think that'll be really fun. And then I want to know a lot about like how recapture might work. And I think they should restrict or limit the circumstances where recapture does happen. But who knows what they'll come out with, but it doesn't make any sense to have recapture in a circumstance where a sponsor sells out their interest in a partnership after they sold the project.
Yeah, and I mean,
after they sold the credits.
and I think what's important here is that the statute's actually very well crafted to allow transactions to happen. It's the parts around the margins that John's really talking about that will benefit from guidance in terms of, okay, how much flexibility do I have? How do partnership allocations work, which get into some of the technicalities of having a partnership. But I think we're in this unique world where I don't see often in my career that people can transact on the statute, and the legal bar is doing a pretty good job of kind of developing contours for what we can do now, and then looking to add these concentric circles of flexibility as guidance comes out.
Well, that's what I'm saying with the big banks. Once the big banks get in, they won't do anything that has any risk. And a lot of times the job of a tax lawyer is to think about the risk, weigh the risk, and come up with mitigants, and not just say there is no risk. So you price in the risk, just like in any business. It's a risk-weighted return.
Great. Perspectives from KPMG, Michael Orlando?
I would personally like to see some more guidance, actually, and quickly, if it could. We are, really going day by day here. I do agree that there's been a number of guidance issued, and the statute is fairly detailed in some cases. In other cases, we need some more. We need to understand how this direct pay mechanism is going to work. For a lot of taxpayers, this will be going on tax returns, these credits. We need to know how that is going to work as well. We have some pretty complicated programs, 48C being one of them, that are going to need a concept paper application. There's a timetable, there needs to be acceptance. So these are things that everyone's working through, and there's still guidance outstanding for programs like that as well. 45X, 30C, these are other ones that we are waiting on some additional guidance, not so much mechanically, but more, again, how and when can we claim these credits? And then also just from an adder perspective, the energy community mapping is one of them. There was a tool that was issued that's not very comprehensive, and there's other areas within those requirements that we'd like to see some further information and better measurement on. So all of these are impending guidance. Again, sooner rather than later would be my preference.
I maybe I overstated. I would love to have more guidance. I don't think we need it on transferability.
Agreed.
Great. So we have a question from Yoav from McGill on how big a minority investment needs to be in order for a step up to be respected. Let's start there with Allen Overy, and then would love to kick it to Michael Orlando of KPMG.
So what I like to say here is that everybody who's looking at this step up and JV interests needs to stop thinking in the context of tax equity and then shift your mind over to a private equity or real estate type model where you have minority investors all the time. There's no question about the arm's length nature of it. And so we need to analyze it just on a pure partnership tax perspective. So if somebody's coming in with a 5% interest and they're really letting it ride, I don't know how the IRS can successfully challenge that transaction if they have meaningful economics. It's no different than having a 5% interest in a skyscraper. I think the market will settle on minimum 5% just because that number is already in existing guidance from the WinRef proc. But really beyond that, it's going to be facts and circumstances and really ensuring that whoever is in there is looking to a return on and of their capital to get repaid. And if those factors are there, the overwhelming case law really supports this transaction being respected.
Yeah, I think where you get into trouble is where people try and play games, where they try and do a sale to themselves. And so we've seen a couple of people say, yeah, 5% is the right number, but that 5% person is going to be like, a sister company, or it's going to be the same taxpayer, but a different LLC within that taxpayer. Those things, I think you're going to jail if you do. If you do it with third-party arm's length, I agree with Sam.
Yeah, I mean, I think the only caution I would have is a JV partner shouldn't come in, sell the credits, keep all the cash from that sale, and then exit, because then that seems to get into the funny business that John's talking about. So if we have a real joint venture with some credit source cash coming as their return and the rest of it from the operation of the property, I think we can get to a really repeatable answer here.
And do you think it matters if you have most of your return through a preferred return? Like in the tax equity world, there have been a lot of fights about whether all the return could be through a preference versus some being variable.
Yeah, I mean, listen, the IRS has issued regulations on safe harbors for preferred returns so that it's never challenged. If people want to go down the safe harbor route for prefs, they can. There's plenty of deals out in the marketplace with PE and funds that do prefs, and everyone's very comfortable that they're equity. So if we kind of work within those contours, I think there's a very solid path forward.
So I think, short story is a lot of the people in the renewables world that are still focused on tax equity have just been religiously tied to these safe harbors that don't really apply in this context.
Bingo.
Mike, Orlando, anything you want to add to that one? And I have a follow-up on it as well.
I would agree. I think the key here, and Allen Overy mentioned it, is meaningful economics, right? Not just doing transactions to lower taxes and looking at it from a true partnership tax perspective. I know for us, these are issues that will be reviewed by our partnership experts, our lawyers in that space, and our Washington national tax teams, and looking at all the things that go into the partnership agreement, and how the agreement is working.
So just following up on this, and this was a question that we got in the chat. John and Sam, you alluded to whether credits transferred out of a tax equity partnership impact the economic substance test. Do you all have a view on that?
Well, if they're transferred out of the deal, then cash is coming in, and the investor will receive cash instead of credits. A lot of times we treat cash and credits as the same. So when we do a pre-tax return, when we're looking at economic substance, we look at the cash invested and we compare it to the cash that comes out plus the credits. If instead of getting credits out, you're getting cash out, then it's even safer.
Great. So over to John and Sam again here. Can you talk about deal terms that we're seeing on tax credit purchase and sale contracts? What sorts of governance restrictions, covenants, et cetera, after the sale is complete?
I think that's it.
Sure. I mean, if you're looking for governance in terms of the partnership that's going to sell the credits, typically just focusing on transferability, the JV partner is going to want some consent rights in the PSA, make sure that their return profile that they expected isn't going to be impacted. I don't see the JV partners coming in as wanting to control the project unless they have a huge interest. A couple deals we've looked at, somebody's coming in for a 20% interest, so they want rights consistent with that type of LP. Review, commentary, maybe some consent rights for material impacts to their financials. And I think we'll see it iterate out from there as people become more comfortable with these deals.
Yeah, I think where you get into governance questions that are really pretty tight are if you have a tax equity transaction, in Sam's example, where there was an investor doing a 30% deal, and now you're trying to sell just the credit portion that relates to an energy community adder, for example. that first tax investor views themselves as the prime, and the second person, really can't supplant them in any meaningful way. So they're going to want a lot more control over approving those contracts or not. Now, what do the buyers get in terms of control? That's been a really good question that we've been wrestling with. Some of the buyers have wanted security interest in the projects. Some of them said, look, I just want notice rights. And a good way to get notice rights is to have some syndicator or independent party come and basically form a partnership with the seller where they can step in and kind of take certain positions that like a tax equity would in a situation in a tax equity deal, but only in the circumstance where there's an audit.
Great. So last question before we close it out, and I'm going to start with Michael Orlando on this. As we move towards more standardized practices here, what do you think are 1 to 2 obstacles that we may see as we move in that direction? And Allen and Overy, would love your perspective there as well, given the work that we've been doing on standardized docs and noting that we don't have much time.
Yeah,
So Michael first.
I think just real quick, I think like anything else, as the volume picks up, sometimes the standardization is going to decrease. There's going to be a lot of different things happening at by different taxpayers, developers, buyers, sellers, so forth. So really just kind of interpreting the guidance on an even keel, and making sure that that there's some ability to streamline that is probably my biggest concern now, but also a challenge that I think we're looking forward to helping clients navigate.
Yeah, I think it's fun because when we started doing tax equity, it really diverged into a couple different markets. We had like the Bank of America forum, and we had the U.S. Bank forum, and those kind of went in two different markets developed effectively. I think we're going to see the same thing here. I think when we have the big banks come in, whenever the guidance comes out, really they're kind of staying on the sidelines for now. They'll have their forum, they'll remove any risk whatsoever, and hopefully the rest of the market has already moved along far enough that they're kind of an also ran and not really getting in the way. Because I think if we can get documents going now, we can cover off all the risks in a way that we either price in the risk or we are eliminating it. We can do it in a very simplistic manner. And to Sam's point, we're doing it consistent with law that applies generally, not like these little nuances in a tax equity deal where people have really just gotten lazy because they none of the people that are in those big banks were the people that developed the products.
Great. So we could have gone on longer, but we're at the hour. I want to thank all the panelists for being on the line. There have been a couple questions in addition to the role of Crux within these transactions. As you all know, we launched the platform publicly a couple of weeks ago, but we are very actively working with people to help find execution on early deals. Rob mentioned that we're currently working through some of those deals very actively. And we're doing that as we build out the software to enable this marketplace to scale to the size that it needs to in order for the number of credits that need to find the market to clear in that market. So creating the software layer to enable the connection between developers, financial institutions and intermediaries, credit buyers and advisors, and building the software to streamline transactions and make the market as large as it needs to be. So we are open for business. We look forward to connecting with many of you. And again, huge thanks to John Marciano and Sam Kamyans of Allen Overy, Michael Orlando of KPMG, and Michael Carr of Boundary Stone Partners. Thanks for being on.